What is going on, YouTube Nation? This is Dark Dividend. If you guys are new to my YouTube channel, make sure you subscribe and hit the notification bell so you don't miss future videos. So this is round 2 of 2. These are monthly dividend stocks that I'm buying. I'm going to go over these monthly dividend stocks. They're real estate investment trusts. These guys have significant dividend increases, and I'm going to go in depth with one of them that you have to be very careful with at the moment. So if you're new, make sure you smash that like button. Make sure you hit that notification bell because I'm pumping out videos like crazy. And tomorrow, while I'm at work, yes, they are making me work. I'm pretty sure I'm 100%. I'm going to reveal to you stocks that I don't like, monthly dividend stocks that did not make my list, and I'm going to explain to you why. So let's check these out right now. And that first dividend stock is EPR Properties. I bought the dip in these guys, and you can tell since the pandemic, they've dropped significantly. And again, they're entertainment properties. So they are a real estate investment trust based on entertainment properties. So of course, they're going to take a hit. And they did not distribute dividends for a certain time frame during the pandemic. And they just resumed their dividend. There's a significant dip right here. And it has a dividend yield of 6.13%, a PE ratio of 372.91, volume of 586.92K, market cap 3.61 billion US dollars. Year range was 3232 to 5607. Of course, I bought the dip. Its day range is 4806 to 4905. So let's check these guys out. So the big thing about these guys, they're the leading diversified experiential real estate investment trust specializing in select enduring experiential properties in the real estate industry. So it's about experiences. So they have 358 locations, 6.5 billion in total investments, 200 plus tenants in 44 states and Canada. So again, this is entertainment. So I'll go over their portfolio real quick. They have AMC, and they're one of the biggest landlords to AMC. Eat and Play, attractions, ski resorts, gaming, experiential lodging, cultural, fitness and wellness, a little bit in private schools and early childhood education centers. So I'll go over their distribution and their map, all their properties that they have, and this is very interesting. But I think the biggest thing that they what are a landlord with is Topgolf. Now, obviously, movie theaters is one thing, but on their website, they reveal to you certain things that they're all about. The IMAX, the IMAX. Let's just take theaters out, and theaters are huge. But these parks, ski resorts, Topgolf. Topgolf is a big one with these guys. And here's some of the ski resorts in Denver, iFly Denver, Topgolf, Eat and Play property. So they know what they're doing. So I'll just take out some of these. So attractions, the lodging, which is big, cultural, fitness and wellness. The fitness and wellness centers is another one. So here's just ski resorts that they have over here. And these are very popular. So I just wanted to show you just certain areas, just clicking. I mean, Boston Mills, which is crazy. I had no idea that these guys were with EPR Properties, and that's pretty cool. Boston Mills and Alpine Valley. So very exciting to see in my area in Northeast Ohio that these guys are a experiential REIT, and they're doing a pretty good job. People that are big into skiing go to Boston Mills in Northeast Ohio. So I find that very interesting. Here's a prep academy in Dublin, Mad River. So there's a lot of resorts that they're doing pretty well with. So just think about that. People are getting out again. People are starting to get active. So these guys are making a comeback. And I'm going to show you how much revenue they're generating. So here's the thing. These guys slowly are making a comeback. So this is in millions of US dollars. And I think they're, pandemic and recession, I mean, they're going to be affected. So, I'm a little bit aggressive with my monthly dividend portfolio. And I had these guys, and I definitely bought the dip. I had a feeling that they were going to come back. And again, this is not financial advice for entertainment purposes, only disclaimer in the description. But these guys are so down, and they're diversified. And the research that they went over on their website, they said that they looked into things with the younger crowd, what they really like doing. and more active things and more gaming and leisure type things people enjoy doing. And actually, Topgolf is pretty fun. You get a few drinks with friends and have a good time, a little bit of friendly trash talking, hitting a golf ball. It's pretty fun. So look at this. So right here, 385, this is in millions of US dollars, 385, 421, 493, 518, 639, 651, then boom, pandemic hit. That's a given. And I'm going to reveal to you their dividend history before they took a huge nosedive. Look at this with EPR Properties. This is starting in 2013. This is 26, 28 cents, 30 cents, 32, 34, 36, 37. Then it hit 38 cents. Then the bug hit and the pandemic. Then it hit 25 cents. So it appears that people have high expectations with EPR Properties with 370.92 of a PE ratio. So you guys tell me in the comment section also what a high PE ratio means. Is it a red flag or is it going to do some damage in the future? So you can interpret it a certain way. I'm telling you, I'm buying more, and people are really targeting this stock right now. There's a lot of articles on them, and they have an annual dividend of $3 right now. Dividend yield is 6.31%, and hopefully, again, this is not financial advice for entertainment purposes only, disclaimer in the description, hopefully their dividend starts going back up again. So they're cheap. I'm reinvesting. I'm probably going to buy more. My goal is to get to 100 or more shares and see what I can do with it. Let's jump to the next dividend stock. And that next monthly dividend stock is Stag Industrial. These guys are all about flexing the muscle. This is industrial real estate investment trust. This is probably one of the only monthly dividend industrial real estate investment trusts. It's sitting at $44.79. Has a dividend yield of 3.24%, a PE ratio of 35.55, volume 1.34 million US dollars, a market cap of 7.60 billion US dollars. Year range was 2940 to 4827. Day range was 4466 to 4546. So there's some interesting information about these guys. I'm glad I got these guys, especially during the dip. And I'm going to go over these guys a little bit. They're a real estate investment trust focused on the acquisition and operation of single-tenant industrial properties throughout the United States. By targeting this type of property, Stag has developed an investment strategy that helps investors find a powerful balance of income plus growth. So, 517 buildings, 40 states, square feet 103.4 million US dollars, enterprise value 8.7 billion US dollars. So here's the thing. EPR was entertainment, experiential, properties, experiential experience, and these guys are more industrialized. So it's good to be diversified, because what happened when EPR took a hit? I still got these guys, and that's the important thing, is diversification of your dividend portfolio, especially your monthly dividend portfolio with your real estate investment trust. I'll go over some properties real quick. Here's just an example. These are all warehouses. These guys are in demand. I'm just using Ohio as an example. So these are all distribution warehouses, manufacturing, and basically, these things are always busy, and they're strong. Basically people are paying their landlords to keep these, and they know what they're doing. They're well balanced. They're well organized, and their revenue is fantastic, which I'll reveal to you. My congestion's like pretty much just about over, but I had to take a break while doing this video because I was hacking a little bit. So the revenue in millions of US dollars is 173, 218, 250, 301, 350, 405, and 483. They're doing something right, and they have an excellent business strategy, and it's working. And guess what? Their dividends are slowly increasing, which I'll reveal to you. Very slowly, they're increasing their dividend. 2014, it was at 10 cents. Then it's just about to hit 12 in 2019. Then it hit 12 cents in 2020. Then it's slowly increasing its dividend again. So you have a slow dividend growth, but it's still going up. If you look right here, 10 cents 11 cents, then it just hits 12. So it's slowly going up there. Not as fast as some of these other dividend stocks, which I'll reveal to you, but it has a decent PE ratio. People have a lot of confidence in these guys. It has a dividend yield of 3.2%, annualized dividend of 145. So these guys are very attractive. It's good to be well diversified. So that's why I have EPR Properties, and that's why I have Stag Industrial Complex. Let me jump to the next dividend. And the stock that they refer to as the monthly dividend stock is Realty Income. That's my third dividend stock I want to reveal to you guys. And this one's sitting at $71.41. It has a dividend yield of 4.14%, a PE ratio of 56.46, volume 4.34 million US dollars, a market cap of 40.41 billion US dollars. Its year range is $57 to $74. These guys are pretty much pandemic proof, recession proof, and they have increased their dividend for a lot of years. So these guys right here, they haven't done well against the S&P since the pandemic. And that makes it very attractive to us as dividend investors. And Realty Income, I'm pretty sure they're part of the S&P as well. But, this is the thing. This is the time that people capitalize on buying stocks like this. And they're so big. I mean, I'm going to go over their portfolio briefly because they're so big. Look at this. After their acquisition of REIT, they have 11,000 commercial properties, a 98.8% portfolio occupancy, 60 different industries. So they have a portfolio of nearly 11,000 commercial properties subject to long-term net lease agreements. Properties are leased in 650 different clients operating across 60 industries and located in 50 states, Puerto Rico, the United Kingdom, and Spain. The majority of our properties are leased, and retail clients have a service, non-discretionary, and low price point component to their business. Maintaining a diversified portfolio helps ensure the stability of our revenue that supports our payment of monthly dividends. And check this out. Their industry diversification is amazing. So they do aerospace, apparel stores, automotive collision services, automotive parts. This is pretty big security right here. Automotive tire services, automotive service. Doesn't matter if it's an electric car, if it's a car that requires gas. People need a car. People need to get to work. Beverages, childcare, consumer electronics, consumer goods, convenience stores. That's big. Crafts and novelties, diversified industrial, dollar stores, drug stores, education, electric utilities, entertainment, equipment services, financial services, food processing, general merchandise, government services, grocery stores, which is big, health and beauty, health and fitness, healthcare, home furnishings, home improvement. I mean, look at this. Packaging, paper, theaters, telecommunications, wholesale clubs. So they're well diversified. And they have all these countries that they're in. And I have to show you the revenue, which is very impressive. So this is in millions of US dollars. 933, 1023, 1,103, 1,215, 1,327, 1,491, 1,651. They're slowly going up, and they're going up. So that's what makes these guys very attractive. And I'm going to reveal to you their dividend history. And these guys call themselves a monthly dividend stock for a reason. Look at this, 18 cents. Then it cracked 19 cents. Then it hit 20 cents in 2016. So you're going from 2013 to 18 cents to 20 cents. And again, this is a monthly dividend stock, then 21. And it hit 22 cents in 2018. So 2017 and 2018, 21 to 22 cents. Then it went from 2019 to 22 cents to cracking 23 cents during a pandemic, pretty much. And then it's cracked 24 cents in 2021. So you're seeing an increase in cents. That's what makes these guys very attractive. I own over 100 shares in Realty Income. And I'm probably going to buy more in the future to get to 200 or maybe 300. I want to start buying more of these guys and let it compound even more. They have a PE ratio of 56.67 and dividend yield of 4.16%. Annual dividend of $2.95. It's almost going to crack $3 for annual dividend just for one of them. And it has a very attractive dividend yield of 4.16%. Let me jump to the next dividend stock. And this dividend stock, this became a monthly dividend stock in 2021. The board of directors basically said and made the call, we're going to be a monthly dividend stock. And I never heard of these guys until they made the call and said that they're going to be a monthly dividend stock. And that's what's really attractive about these guys is I like the monthly dividends. They're sitting at 69.22. They have a dividend yield of 3.93%, a PE ratio of 39.37, a volume of 687.74K, a market cap of 5.34 billion US dollars. Zero range was 61.27 to 75.95. Day range was 68.99 to 70.04. Previous close was right at $70.08. These guys are a rival to Realty Income, and I'll go over a little bit of their dividend growth rate versus Realty Income after I go over these guys. So today, Agree Realty is a $6+ billion industry leader in the acquisition and development of properties net leased in the foremost retailers in the United States. As of December 31st, 2021, the company owned and operated a portfolio of 1,404 properties located in 47 states and containing approximately 29 million square feet of gross leasable space. So this is what I like about these guys. And I'm going to go over their properties. It's almost like a mirror image of Realty Income. There's a lot of security with these guys and the companies that they have. So here's Academy Sports, Aaron's Rents, Advanced Auto Parts. There's a ton of them right here. And this is Aldi, that's a big place. Amazon Fresh, AMC, Applebee's, Ashley Furniture, Aspen Dental. I mean, people need their teeth cleaned at home. AT&T stores, Athletico, AutoZone. I mean, this is just in alphabetic order. So you're seeing it there's a lot of AutoZone. You're seeing a lot of these things that people pay rent for. People need cars. People need parts of cars. Here's Bank of America, Bass Pro Shops, BB&T, Bed Bath & Beyond, Bell Tire. People need tires. Best Buy is another one. I mean, look at this. Diversification, CVS, Dollar General. I mean, I'm just going Family Dollar, Gerber. I think, did they have Fresenius Medical Care? That's pretty much like a dialysis center. There's a lot of sick people and they need dialysis, rise of diabetes, hypertension, all that. Get-Go, Giant Eagle. Oh, there's a Giant Eagle. That's pretty interesting in Pennsylvania. Where I shop sometimes. Goodwill, Goodyear Tire and Rubber. Gee, Goodyear is not in demand. Great Clips, grocery outlets. So you're seeing the diversification. Michaels, NTB. Gee, people need batteries, don't they? O'Reilly Auto Parts. You're seeing what they bring to the table, which is extremely attractive. And I'm going to jump to their revenue and their dividend history. Let me just show you their revenue in trends. And this is what's very attractive, and this is incredible. So this is in millions of US dollars. 53, 69, 91, 111, 137, 187, 248. So that's a huge jump in revenue. And again, that's during the pandemic. So these guys are generating some firepower right now. And I'm going to go over their dividend history. Look at this. So you could tell when they break off to the quarterly dividend to the monthly dividend. So right here, it's hit 20 cents, then 21 cents, and then it hit 22 cents. They have a dividend yield of 3.9%, a PE ratio of 39.63, an annual dividend of 272. There's one thing I want to show you comparing ADC to Realty Income. Let's go over O first. The FFO growth is 6.55%. FFO is important. AFFO is important. 5.94%. EPS diluted growth, 5.92%. Revenue growth, 28.76%. Diluted growth in 10 years, 5.11%. Dividend growth rate in 5 years, 3.55%. Dividend growth rate in 3 years, 2.73%. Dividend growth share growth FI1 to FY3, compounded annual growth rate 2.30%. Dividend share growth FY1 2.92%. Dividend growth rate is 2.15%. So let's jump to Agree Realty Corporation, which makes things very interesting. So there's a few things. The FFO growth is 7.90%. The AFFO growth is 7.76%. The diluted growth is 1.1%. negative 1.15%. The revenue growth is 31.44%. Dividend growth rate in 10 years is 4.99%. Dividend growth rate in 5 years is 6.28%. Dividend growth rate in 3 years is 6.51%. Dividend per share growth FI1 to FI3, compounded annual growth rate is 3.69%. Dividend per share growth is 6.66%, and the dividend growth rate is 8.27%. That's a little bit higher than Realty income. Now I want to go over just one more monthly dividend stock. I didn't add SLG to this one. I'll go over that one in the future, but this one I need to go over with you guys. There are some things that are very interesting that need to be addressed. And I own this one and I'm long on it, but I just want to go over some things that are, some red flags that are popping up. Let's check out this last dividend stock. And that last dividend stock is LTC Properties. It's sitting at $35.80. It has a dividend yield at 6.37%. PE ratio 23.32. Volume 330.14K. Market cap 1.41 billion US dollars. Year range was 3136 to 4473. Day range of 3525 to 3604. Previous close was 35.42. So there's a few things. So this is why I own, and I'm well diversified with my monthly dividend real estate investment trust. So LTC Properties is a medical one, which I'll go over with you guys. ADC and Realty income are very well balanced. They have a lot of things that they're well diversified on. So, I have two well diversified stocks. Stag is focused on industrial properties, basically, and warehouses and all that. So that's diversification. And then EPR Properties is obviously entertainment properties for the experiential, movement and the experiential, how do you want to say it? Experiential, experiences. I guess I'll just say it that way. EE. There you go. So that's the thing with these guys. So let's go over LTC Properties. So focus on senior housing and healthcare properties. LTC's portfolio is broadly diversified to provide a balanced revenue stream from private pay sources and government reimbursement. We strategically leverage successful existing partner relationships to expand our portfolio while being mindful of operator concentration. So these are well-known assisted living facilities. So these guys are always busy. There's always a demand to send people to facilities because, they get strokes, they get sick, they get a heart attack, their ejection fraction drops from getting a heart attack, COPD, smokers, people, just weak from fighting off a bug or something. So this is very important. So these guys are in demand, which is very important to the elderly population and the baby boomer population. But there's a few things that need to be addressed with these guys, and I'll go over that with you guys. And these are some things I need to go over with you guys. So the FFO payout ratio, okay, want to be, obviously, you don't want to be at 100%, but they're pretty close. That's a problem. So the AFFO payout ratio is 97.46 right here. So they're in the 90s. Gross profit margin 70.32. So the debt right here is high. This is extremely high at 508.06%. So the dividend payout ratio, that's high. Okay, that's a red flag. 161.82%. The dividend payout ratio, again, ETM, 148.42%. Dividend payout ratio right here, the GAAP, 148.05%. This is really high, and this is a problem, okay? Right here, the difference to the sector. Cash dividend payout ratio is 90.37. That's a red flag. So I'm just telling you. I'm going to go over their overall revenue and their dividend history then. And again, this is not financial advice for entertainment purposes, only disclaimer in the description. I'll say that 1,000 times. But you're seeing some trends here, some good trends, and all of a sudden it just went down. So This is in millions of US dollars. 118, 136, 161, 168, 185, and then 159. Here's the problem. This is like the perfect storm. This is just like what happened to entertainment properties. Unfortunately, people were scared. I'm going to tell you, people were scared to death. People still are, to go to these assisted living, skilled rehab facilities because it's a breeding ground for the bug. That's a big problem. People are very hesitant on going to skilled rehab right now. That's a problem. I can tell you, I can't even tell you how many people that I've taken care of as patients that didn't want to go to rehab. They were just scared. I don't want to get the bug. And it didn't matter if we swab people, did random swabs with patients, and they're going to be sent to facilities. They just don't do that, and they just don't want to. They just don't want to go. So that was something that it was the perfect storm. And unfortunately, people passed away, obviously living in some of those facilities. So, and then people didn't want to come in. So then sometimes they're not at full capacity. And then they acquire all these facilities, and they're expecting, revenue to pay off some debt. Again, this is just from what I've read, that seems like that's what's going on, and what from people have said in some articles. Don't quote me on that, but this appears, and this is me seeing it firsthand with things going on. And I'm not giving financial advice. I'm just telling you this is what's going on throughout the country right now. Is people are just scared to death, and these guys just boom, this hit them. And again, you look at MPW and OHI. I mean, it's like, what's going on here? And I think I really do believe that people are hesitant to go to these facilities because of the bug. And they're scared to come out of their houses, and they just don't want to do things, and they want home health, and they shouldn't be requiring home health because they need to go to these facilities. So this is going to be a roadblock for a little bit of time. And I'm going to jump to its dividend history. And from what my statements were previously that I was saying about LTC Properties, you guys can correct me if I'm wrong. Put it in the comment section, from what people are saying, but it's just the perfect storm. And look at this. 15 cents, and they hit 17, then they're doing great at 18, then they're just stuck at 19 cents. They haven't improved at all. Their revenue was going up, but they have a lot of internal issues that need to be fixed, and that's a little bit of a roadblock currently. They have a 6.49% dividend yield and a PE ratio of 23.01, annual dividend of $2.28. So the thing is, these guys have all these issues they got to work on. Now, I didn't do SLG Properties. I'll do that in the future as a monthly dividend stock, but I really wanted to emphasize these ones. I'm still going to buy this one. I wouldn't be surprised if they cut their dividend because of debt. So I just want you guys to be aware of this one. This is why I wanted to do a video on these guys instead of SLG. So let me know what you think of this video. If you are new to this channel, make sure you subscribe and hit the notification bell so you don't miss future videos. I'm going to do a video tomorrow. I'm going to have it saved for you guys. I'm going to have it done by probably 12 noon tomorrow. And these are monthly dividend stocks that didn't make the cut on my list. You guys take care. I'll see you in the comment section, and have a good one.